Welcome to the deep dive. Today we're tackling something that sounds simple, but really isn't revenue. It's that top line everyone talks about.
Right. You sell something, you get paid. Seems obvious.
Exactly. But in reality, especially now, figuring out when to actually count that money, well, it's incredibly complex. Financial execs even point to it as a big area for error, sometimes even fraud.
It's surprisingly easy to get wrong.
So our mission today is to unpack Chapter 17 on revenue recognition from Kieso, Weygandt, and Warfield's intermediate accounting. We want to cut through the jargon, give you a clear picture of how companies earn and report their money, without drowning you in details.
And the core idea, really, is pretty simple at heart. It's about showing accurately when a company transfers goods or services to you, the customer.
Right.
And does so for the payment it genuinely expects to get back. It's not just counting sales. It's about understanding a company's real performance and, frankly, its sustainability.
Okay, so let's dive into the framework. The FASB, the accounting rule makers, set up this 5-step process. It applies pretty much across the board, trying to bring consistency. It's kind of an asset liability approach, focusing less on just cash and more on how contracts change what a company owns or owes.
Exactly. It's a more rigorous way to pinpoint when the earning actually happens. So those 5 steps are crucial. You ready?
Lay that for us.
Okay. 1, identify the contract with the customer. Simple enough start.
Okay.
2, identify the separate performance obligations, basically, the promises in that contract.
Promises. Okay.
3, figure out the transaction price. How much money are we actually talking about?
Right.
4, allocate that price to each of those separate promises or obligations.
Split it up.
And 5, recognize the revenue when, or sometimes as the company satisfies each promise.
Okay, let's make this real. Our favorite coffee shop, Bean. I go in, buy a coffee, $3.
Okay.
Walk us through it.
Step 1, identify the contract. You order, they agree to sell, you pay. Check. It's a valid agreement.
Got it. Step 2, performance obligations.
Just one promise here. Deliver that coffee.
Makes sense. Step 3, transaction price.
Clearly $3.
Step 4, allocate.
Easy. Nothing to allocate. It's all for the coffee.
And step 5, recognize the revenue.
Right when they hand you that cup, you've got control, physical possession, the risk of spilling it.
Hopefully not.
Right. So Bean earns the $3 then and there.
Okay, now I get the coffee, $3 and 2 bagels for $5. Total $8.
Okay, steps 1, 3, and 5 are similar. Contract exists for $8. Revenue recognized when you get the items.
But step 2 changes.
Exactly. Now, Bean has 2 separate performance obligations. The coffee is distinct, the bagels are distinct, you could buy them separately.
Ah, okay, they aren't tied together.
Precisely. So Bean satisfies 2 promises.
Now let's tweak step 3, the price. Bean has smoke jumper beans, normally $10, but on Tuesday, they're $9. I buy them Tuesday.
The transaction price isn't 10, it's 9. That's what Bean actually expects to get from you today.
So they recognize $9. It's the actual expected price, not the list price.
Correct. And for step 4, allocation, let's say Bean bundles their fancy mocha beans, normally $12, with a large coffee, normally $3, for a total of $13.
Okay, a deal.
Right. So the total standalone price would be $15, right? 12 plus 3.
Yeah.
Bean allocates that $13 bundle price based on those standalone prices. The beans are 12/15, or 80% of the value. So they get allocated $10.40 of the revenue.
Okay.
And the coffee is 3/15, 20%. So it gets $2.60. Even in a bundle, each part gets its fair share based on what it would sell for alone.
That framework seems clear for Bean, but I can see how it gets complicated fast in bigger businesses.
Oh, absolutely. These simple steps involve huge judgments in practice. Let's dig a bit deeper into each one.
Sounds good. Start with step 1, identifying the contract.
Okay, a contract is just an agreement, written, oral, even implied, that creates rights and obligations you can enforce.
So, like, a formal document isn't always needed.
Not necessarily, but the key things are, it has commercial substance, both sides approve it, the rights and payment terms, and crucially, the company thinks it's probable they'll actually collect the money.
Ah, collection is key up front.
Yes. And remember, just signing isn't revenue. Take Margot Company, agreeing to sell a product for $5,000. No revenue happens on signing.
Right.
Only when Margot actually delivers that product do they recognize the $5,000 in sales revenue, even if the cash payment comes later. It's about fulfilling the promise.
So that collectability point,
Yeah.
it's part of deciding if you have a contract, not how much revenue to recognize later.
Exactly. If specialty chef sells $800,000 worth of knives and believes they'll collect, they recognize the full $800,000 revenue.
Okay.
If they later estimate, say, 2% won't be collected based on history, that's handled separately, becomes a bad debt expense and operating cost. You don't go back and reduce the original revenue.
Got it. Separates the sale from the credit risk. Now, step 2. Identifying separate performance obligations. You said promises.
Right. Distinct promises. A product or service is distinct if, 1, the customer can benefit from it on its own or with other readily available resources.
Like a coffee and bagels.
Exactly. And 2, the promise is distinct within the context of the contract, meaning it's not highly dependent on or interrelated with other promises in the contract.
Okay, give us contrast.
Think GM selling a car with 6 months of telematics. Those are likely separate. The telematics has value on its own. You could potentially get it elsewhere, and it's not essential to the car functioning as a car.
Makes sense.
Now, contrast that with SoftTech Inc., licensing software, but also providing extensive mandatory customization to make it work in the client system.
So the software is useless without the specific customization.
Pretty much. The software and the service are so intertwined, they really form one single combined performance obligation, delivering a working customized system, not just software plus service.
That distinction seems crucial. Okay, step 3. Determining the transaction price, the money part.
Right, the amount the company expects to be entitled to receive. It's not always fixed. You've got variable consideration, time value of money, and even consideration paid back to the customer.
Variable consideration, like discounts, bonuses.
Exactly. Or royalties, rebates, things where the final amount depends on some future event. Companies have to estimate this.
How?
2 main ways: expected value, a probability-weighted average of possible outcomes, or the most likely amount if one outcome is far more probable than others.
Okay, like Peabody Construction, building a warehouse for $100, but maybe a $50 K bonus if they finish on time.
Perfect example. If the bonus shrinks each week they're late, Peabody has to estimate the probability of finishing on time 1 week late, 2 weeks late, etc.
Right.
They'd use those probabilities to calculate an expected bonus amount and add that to the $100 to get the transaction price. It's an upfront estimate of what they'll likely earn.
So it reflects the uncertainty.
Yes, but there's a catch. The revenue constraint. You only include variable consideration in the price if it's highly probable that a significant reversal of that revenue won't occur later.
Don't count your chickens.
Pretty much. If the outcome is too uncertain, you wait. Like Share Company managing investments. They can recognize their fixed quarterly fees.
Sure.
But a big performance bonus tied to volatile market returns. They might have to wait until year-end when that uncertainty is resolved before recognizing that bonus revenue.
Makes sense. What about time value of money?
If there's a significant financing component, like payment is way before or way after delivery, you often need to adjust.
Like selling something today, but getting paid in 4 years with no interest stated.
Exactly. Say SEK sells goods for $900,000 cash value, but accepts a 4-year zero-interest note for, let's say, $1,416,163.
Okay.
They recognize $900,000 sales revenue now. The difference, that extra $516,163 isn't sales revenue. It's treated as interest revenue and recognized over the 4 years.
So you separate the sale from the financing.
Correct. And finally, consideration paid back to customers like volume discounts or rebates usually just reduces the transaction price up front.
Like Samsung offering a 3% discount if Artico buys enough.
Right. If Samsung sells $700,000 to Arctic and fully expects them to earn that discount, they'd probably recognize revenue of $679,000.
Yeah.
700 cares less, 3% right away. Reflects the reality of the expected price.
Okay, that covers price. Now, step 4, allocating that price. You mentioned splitting the pie.
Yes, when you have multiple performance obligations, you allocate the total transaction price based on their relative standalone selling prices, what each item would sell for on its own.
And if you don't know the standalone price?
Good question. There are estimation methods. You might look at market prices for similar things. That's the adjusted market assessment approach.
Okay.
Or you could estimate your costs plus a normal profit margin, expected cost plus margin. Or sometimes if one price is really uncertain but others are known, you might use the residual approach.
Let's use that handler company example. Selling equipment, installation, and training. Let's say the total price is $2,050,000.
Right. And standalone prices are, say, $2 for equipment, $20K for installation, $50 for training. Total standalone is $2,070,000.
So you'd allocate the $2.05 messers based on those proportions.
Exactly. The equipment gets the biggest chunk, installation a small slice, training its share. Then, as handler delivers each part, equipment shipped, installation done, training provided over time, they recognize the allocated revenue portion for that part.
So revenue recognition follows the delivery of each distinct promise.
Precisely. Which brings us neatly to step 5, recognizing revenue when or as each obligation is satisfied.
The final step. It all comes down to this.
It does. And the trigger is transfer of control. When does the customer gain control of the good or service?
And control means?
They can direct its use, get basically all the benefits, and stop others from using it. Indicators include having the right to payment, legal title, physical possession, the risks and rewards of ownership, and customer acceptance.
Like getting the coffee at Bean. That's control transfer at a point in time.
Exactly. But sometimes control transfers over time.
When does that happen?
3 main scenarios. 1, the customer receives and consumes the benefits as the company performs think cleaning services. 2, the company's work creates or enhances an asset the customer controls as it's created, like building on the customer's site.
Okay.
Or 3, the company is creating an asset with no alternative use to the company. And the company has an enforceable right to payment for performance completed to date.
That sounds like the custom software example Gomez Software building for Hurley Company.
Perfect fit.
Mhm.
The software is custom, Gomez can't sell it elsewhere, and they have a right to payment as they work. So Gomez recognizes revenue over the period they are developing and installing it, not just all at the end.
Okay, that 5-step model seems robust, but I bet there are tricky real-world situations.
Oh, always. Let's hit some common ones. Sales, returns, and allowances.
Right, people return things. How does
Yeah.
that affect revenue?
Companies should only recognize revenue they're reasonably sure they'll keep. So, you estimate expected returns based on history or other factors.
So if Epic Co. sells $5,000 of video games, but expects, say, 6% returns,
They'd recognize slightly less than $5,000 in net revenue initially, or adjust it later. They'd also set up a refund liability for the cash they expect to return, and an estimated inventory returns asset for the cost of goods they expect to get back.
it's proactive. And like you mentioned, with huge retailers like Amazon, estimating this accurately is a massive data science challenge, given returns run into hundreds of billions.
Absolutely. Next up, repurchase agreements.
Where a company sells something but agrees to buy it back.
Yes, especially if they agree to buy it back for the same price or more. If Morgan Inc. sells equipment for $100K, but has to repurchase it in 2 years for $121K.
That doesn't sound like a real sale.
It usually isn't treated as one. It's generally accounted for as a financing transaction. Morgan gets cash, records a liability, and accrues interest expense over the 2 years. They essentially borrowed money, using the equipment as collateral.
Got it. What about bill and hold? Billing the customer but keeping the goods.
Yes, this can happen, but revenue recognition requires meeting strict criteria. There has to be a substantive reason the customer requested it, the product must be identified as theirs, ready to ship, and the seller can't use it or sell it to someone else.
Like Butler Company holding fireplaces for Baristo's new stores, if all those conditions are met.
Then Butler can recognize the revenue when control effectively transfers to Baristo, even though Butler still physically holds the items. Control, not just possession.
Okay. Principal-agent relationships, like travel agents.
Exactly. The agent, travel agent, facilitates the sale for the principal airline. The agent's revenue is just their commission, not the full ticket price.
So Flyaway Travel selling a British Airways ticket only records their 6% commission as revenue.
Correct. British Airways, the principal, records the full airfare. Consignment works similarly. The consignee store sells goods for the consignor manufacturer. The consign only records commission revenue. The consignor records the sale revenue when the goods are ultimately sold to the end customer.
What about warranties? My car came with one.
2 main types here. Assurance-type warranties just guarantee the product meets agreed-upon specs at the time of sale. It's not a separate promise or performance obligation.
So the cost is just estimated and expensed.
Right, you set up a warranty liability. But service-type warranties offer something extra, beyond basic quality like an extended warranty. That is usually a separate performance obligation.
Ah, so if Maverick Company sells Rollomatics with a standard warranty and sells an optional 3-year extended warranty.
The revenue from selling the Rollomatic is recognized upfront, but the revenue allocated to that $18,000 extended warranty, that's recognized over the 3-year service period.
Matches revenue to the service provided.
Okay, last one. Non-refundable upfront fees, like gym initiation fees. Often, yes. If that fee relates to future services or access, it's generally not recognized all at once.
So Bigelow Health Club's $200 initiation fee, if members typically stay 3 years.
You'd likely allocate that $200 plus the monthly fees over the expected 36-month membership period, recognizing a smooth amount of revenue each month. It represents the ongoing service access.
Wow, lots of nuances. So how does all this look on the actual financial statements?
Good question. Presentation matters. You'll see things like contract assets and contract liabilities on the balance sheet.
That's a difference.
A contract asset is the company's right to payment for work done, but the right is still conditional on something else happening, like finishing another part of the job. Once the right becomes unconditional, only time has to pass, it becomes a regular accounts receivable.
Okay.
A contract liability is when the company has received payment or has an unconditional right to payment, but hasn't delivered the goods or services yet. Think unearned revenue.
So Finn delivers product A, but payment depends on delivering product B later. That initial right is a contract asset.
Likely, yes. Then, if Henley gets paid up front for goods they'll deliver next month, that's a contract liability.
Got it. What if contracts change midstream? Contract modifications.
If the change adds distinct good services at their standalone prices, it's often treated as a whole new contract. No impact on the old one.
Simple enough.
But if not, it's usually a modification of the existing contract. Often you'll recalculate a sort of blended price for the remaining goods or services and apply that going forward, a prospective adjustment.
Like Crandall adding more docking stations. If it's basically a new order at market price, new contract. If it modifies the original deal, you adjust prospectively.
Exactly. And don't forget costs to fulfill a contract. Some costs directly related to getting or fulfilling a contract, especially long-term ones, can be capitalized.
Like sales commissions on a multi-year deal.
Yes, if incremental.
Mm.
Also, direct labor and materials used specifically for the contract might be capitalized. But general admin costs, usually expensed as incurred.
So Rock Integrators capitalizes the commission and specific design hardware costs for a client project, but not general testing costs. Match costs to revenue.
That's the idea. And finally, companies need good disclosures. They have to explain their revenue policies, significant judgments made, details about their contract balances, and remaining performance obligations. Transparency is key.
Makes sense. Now, quickly, what about those really long-term projects like construction?
Right. Long-term construction contracts, often recognized over time. The main method is percentage of completion. You estimate the total cost, figure out the percentage you've completed so far, often based on costs incurred total estimated costs, and recognize that percentage of the total revenue and profit each year.
So Hard at Construction building a bridge recognizes revenue gradually as they build it.
Yes, provides a better picture of ongoing performance than waiting years until it's totally done. If estimates change mid-project, you adjust prospectively catch up in the current period.
What if they can't reliably estimate the outcome?
Then they might use the cost recovery method. Recognize revenue only up to the costs incurred until you can estimate reliably. Basically, zero profit until you have a clear picture, then recognize all profit at the end or when certainty improves.
And losses. What if they realize halfway through it's going to be an unprofitable contract?
You recognize the entire expected loss immediately under both methods. No delaying bad news.
Ouch. Okay, one more special case. Franchises.
Complex because they often bundle lots of things. The brand license, training equipment, ongoing support.
Like Tum's Pizza selling a franchise, that initial fee might cover several things.
Exactly. You have to identify the separate performance obligations. If the initial fee covers distinct items like training and equipment delivered up front, that revenue is recognized when delivered.
Okay.
But if a large part of the fee is really for the ongoing right to use the brand and benefit from updates over, say, 5 years, like for TechSolver's Core, then that portion of the fee is recognized over the 5 years. Ongoing royalty payments based on sales are typically recognized as those sales occur.
So it always comes back to identifying the distinct promises and when they're fulfilled.
That's the essence of it. These rules, complex as they seem, really aim for a clearer, more comparable picture of how companies generate value. From coffee to construction cranes, it's about the substance of the transfer.
So what this really means for you, listening, is that understanding these revenue recognition details is critical. Whether you're a student, an investor, or just curious about business, it helps you look past that top-line number and see the real story, the potential risks, the judgments involved. It lets you make much more informed decisions.
Absolutely.
So here's a final thought to mull over. Think about your favorite subscription service, streaming, software, whatever, or maybe a big construction project you see in your city. How do you think that company is recognizing its revenue? What assumptions might they be making behind the scenes that affect the financial health they report? Something to ponder.